The statement of changes in equity is vital for understanding the dynamics of a company's equity. It not only provides transparency for investors, but also serves as a critical tool for assessing financial performance and stability. A pleasant day, everyone. For today's agenda, we will discuss about the consolidated statement of changes in equity of Bloomberrry Resorts Corporation. Now, let's start with its net income. As shown in the table, it's shown that it's increased by 85.2%. Also, the share base increased to 74.3% from its previous years. And the company issued new shares in the current year amounting to 5.4 billion pesos. On the other hand, our share capital has increased by 5.1%. This growth indicates a positive reception from investors and suggests confidence in our company's future performance. We've observed an increase in treasury shares to 18.5%. This rise could suggest a strategic move to repurchase shares, potentially to improve earnings per share or to prepare for future employee compensation plans. Furthermore, a remarkable increase in retained earnings of 89.1% stands out. This significant growth implies that we are effectively reinvesting profits back into the company rather than distributing them as dividends. Interestingly, the cost of share held by subsidiary remains unchanged from the previous year. This stability might indicate that our subsidiaries are maintaining their performance or that there hasn't been a need for strategic restructuring or additional investment in those areas. And now, let's open the floor to the financial ratios of the company.
Moving on, the Bloomberrry Resorts Corporation ratios, we came up with the following analysis. The price to earnings ratio has decreased from 16.1 in 2022 to 11.4 in 2023. This represents a decline of approximately 29.1%, the decrease in the PE ratio from 16.1 in 2022 to 11.4 in 2023 suggests that the stock is less expensive relative to its earning compared to the previous year. This could be due to a decline in stock price and assistance earnings or a combination of both. On the hand, the diluted earnings per share in 2023 is 0.86 is slightly higher in 2022, which is 0.47. This 83% rise indicates that the company's profitability has improved over the year. Also, due to its increase in the net income, it suggests enhanced financial performance and potentially effective cost management or increased revenue.
Let's proceed to the return on equity of the company. The ROE improved from 15.5% in 2022 to 19.7% in 2023. This increase signifies that the company has enhanced its ability to generate profit from shareholders' equity. A higher ROA indicates the company is providing a better return on the investment made by its shareholders. This improvement may result from increased profitability, efficient use of equity, or a combination of.
The overall trend of decreasing debt ratios and increasing equity ratios suggests that the company is improving its financial health. This can lead to a more stable financial position and potentially lower interest cost. While a debt-to-equity ratio of 2.32 and a debt-to-asset ratio of 0.59 still indicate a reliance on debt. The improvement suggests that the company is taking steps to manage its risk better. The increase in the equity-to-asset ratio is particularly encouraging, as it indicates a shift towards a more balanced capital structure. Maintaining a balance between debt and equity is crucial for financial stability. If the company can continue to improve its equity position while managing its debt levels, it may be well positioned for future growth and resilience against economic fluctuations.
In 2023, the company's financial metrics show improvement across several key indicators. compared to 2022. The price-to-earnings ratio has decreased from 16.1 to 11.4, suggesting that the stock may be undervalued or that earnings have improved relative to its price. Diluted earnings per share have increased significantly from 0.47 to 0.86, indicating stronger profitability. The debt-to-equity ratio has decreased from 3.26 to 2.32, reflecting a reduction in leverage and improvement financial stability. The return on equity has risen from 15.5% to 19.7%, highlighting enhanced efficiency in generating profits from shareholders' equity. Additionally, the equity-to-asset ratio has improved from 0.23 to 0.30, signaling a stronger equity position relative to the company's asset. Overall, these improvements suggest a more robust and financially stable company in 2023 compared to the previous year.
Recommendations: continue to focus on reducing leverage and reducing debt. The debt-to-equity ratio has lowered from 3.26 to 2.32, indicating lower leverage and more financial soundness. While this is a favorable trend, the corporation must maintain or enhance its leverage ratios to ensure long-term financial health and risk management. Monitoring and managing debt levels should be a top responsibility. Next, leverage the improved ROE to drive further growth. The ROE has risen from 15.5% to 19.7%, demonstrating that the company is getting more efficient at generating profits from shareholder equity. To maintain and potentially accelerate this favorable trend, the organization should continue to focus on initiatives that improve operational efficiency and profitability. Lastly, maintain or strengthen the equity base to further enhance the equity-to-asset ratio. The equity-to-asset ratio has improved from 0.23 to 0.30, showing a stronger equity position relative to its assets. To further strengthen financial health, the company should consider strategies to continue improving this ratio, such as increasing equity or managing asset utilization more effectively.